We're here in New York City at the Waldorf Astoria Hotel for REIT World 2010. Joining me is David Goldschmidt, partner with Skadden Arps Slate Meagher and Flom. You and I talked about the potential for the development of more mortgage REITs in this market. How do you see things going there now?
Well, for some mortgage REITs have had very successful year in 2009, 2010. For example, we've helped raise over $1 billion for American Capital. Invesco raised almost $1 billion, and Cypress Sharpridge raised almost $500 million. These mortgage REITs were able to raise money basically on their investment strategies of investing in mortgage-related assets, of agency-related assets. Other mortgage REITs have had a more difficult times, those who have been investing in mezzanine loans or B notes. Those companies have had challenging financing times at the market and have been unable to access those markets. It's going to be interesting to see how all that shakes out. I think what you'll see is some agency REITs that have been able to access the market will expand, invest in RMBS and CMBS that are not agency related, and perhaps they will be able to get better returns that way.
And then what about on the equity REIT side? You know, there's been a lot of talk about the possibility of IPOs of these companies coming public. What are some of the big holdups that might be, kind of constraining that IPO activity right now?
Well, I think REIT IPOs are not easy to do. They take a lot of time. And we have been seeing increased activity and increased discussion. As you well know, 2009, 2010 proved the point that REITs are a very good investment vehicle or ownership vehicle in good times and in bad times. And so private companies who are now trying to rejigger their balance sheets, trying to roll up their different partnerships, and that's what's holding things up, is that most of these real estate investments are multiple partnerships that they have to deal with their partners and cashing them out on valuations that are not as high as they were back 3 years ago. And so I think they're going through the steps of figuring out the values of the company, dealing with their partners, and getting the companies ready to go public.
And then in your discussions with some of your clients, what do you think has been the greatest lesson that they've taken away from the past couple of years in terms of the financial crisis?
People were quite concerned with the wall of debt, still are concerned with the wall of debt. But public companies took the hit on the equity. They've all, major REITs all raised equity, and I'm sure they all believe that they sold equity at prices way too low, and they probably did. But the market required them to re-equitize, put some cash on their balance sheet, and by doing so, they were able to refinance debt, take short-term debt, push that out into long-term, refinance expensive debt for cheaper debt, and now have a very good cushion, both in cash and as well as short-term maturities, to go out and take advantages of the market right now.
Thank you very much for your time, David.
My pleasure.
For more on REIT World 2010 and more REIT news and analysis, check out REIT.com. I'm Alan Kenny.